It happened. First time since 1994, the largest rate hike, 75 basis points. It happened on Wednesday, June 15th. Eric Finnegan, a director at John Burns Real Estate Consulting, wrote on Twitter, mortgage rates rising from 3% at the start of this year to 6% effectively rules out 18 million households from qualifying for a $400,000 mortgage. Obviously, our local median prices is about 3 to 4 times of that. And what does that mean here locally? And what can we do to reduce the negative impact and reap the benefit? Yes, there is a silver lining in this. And let's dig right into it. Hi, this is Michael Chu of 7M Realty here in Fremont, Silicon Valley. If you agree, we bring good information and analysis for the understanding of the market. All we ask is to like and subscribe so you won't miss out on any of our episodes. A little bit of a perspective. So 75 basis point hike is like setting a domino effect in motion, which will have a chain reaction that impacts the entire market. At the core, these interest rate changes have a significant domino effect throughout everything from housing, auto, food, gas, travel, basically everything on a daily basis surrounding our work, travel, and entertainment. It includes auto loans, credit cards, and just about everything we buy and trade, and the list goes on. And that's why it is incredibly important. And that's why we're seeing such a violent reaction in the stock market the day after, with the Dow losing another 700 points. And by the way, this is on top of all the stock indices, which were already in bear market territory. As we ease into the topic, it would mean a lot to me if you hit the like button, subscribe, which encourages my team tremendously. It makes all the research to bring you up-to-date information so you become an informed buyer or seller in this volatile and shifting market. Completely worth it. And as a thank you for doing that, here's a picture of our beloved Tommy and Jerry. We adopted the brothers from a barn 2 years ago, and they have awakened in us that we are actually animal lovers, but just didn't know that for most of our life. So thank you. Thank you guys so much and for keeping us motivated. All right. As of today, we are already seeing the effects of a slowdown in the real estate industry. The real estate company Compass announced a 10% job cut on the same day as Redfin, who also announced a 6% job cut. I am part of many Facebook group within many mortgage lenders, and in this last couple of days, more than half a dozen mortgage processors in the group have reported being laid off as mortgage companies anticipate or seize the drop in mortgage loan processing. Elsewhere, Coinbase announced an 18% layoff this week after Facebook, Nvidia, and Netflix announced they are also slowing down or pausing hiring and speeding up their attrition. Many startups funded by VCs in Silicon Valley also announced a layoff in the last week, bringing the pain of inflation taming into real-life events here in our area. Our most large or small firms in our areas are also in hiring freeze and hiring very cautiously. So the tightening of money supply reaches into every aspect of our life, including the financial market, labor market, and housing market. Increasing interest rate makes it significantly more expensive to borrow money, with the Fed Reserve actively removing money from the system throughout what's known as the balance sheet runoff. It will be more difficult for companies to do as well as they have been in the previous time frame. They say rising tides lift all boats, and its opposite is also true when the tide is receding. When the money supply tide is retreating, companies feel the pinch, and without easy access to capital, it is hard to expand. At the consumer level, just from the announcement of a higher Fed rate, mortgage rates immediately spiked by 30 basis points to nearly 6%. For comparison, back in November 2021, we were at 2.8%. As a result of a higher interest rate, mortgage applications are down 29% from a year ago. And all of this means that housing prices have reached a point where fewer buyers are able to qualify. When mortgage broker Jeff Lazarson quoted a 6% rate for a client this week, he thought it was a mistake. The last time 30-year rates were that high was late 2008, when policymakers plunged the world into an era of ultra-low rates to pull economies back from the brink. What he said was, "What a shocker." The president of Mortgage Grader Inc. in Laguna Niguel, California, he continues on saying, "My sense is we're seeing a very nasty recession. We have much less demand, and as more inventory builds up, that means home prices growth begin to slow." Now, nationally, about 21% of sellers dropped their asking price during a 4-week period ended through June 5th, up from 10% a year earlier, and the second highest share on records dating to 2015, according to Redfin. Personally, I have been helping investors buy single-family homes for rentals since early this year. In the beginning, it was really challenging. Even as cash buyers, having to compete with so many multiple offers and not enough houses to choose from made it really difficult. But since April, I can really see the advantage of cash offers. In 2 of these instances, we were able to go in with offers lower than the list price. With more inventory, we also had more options, and both of our lower than listed offers did get accepted. It worked out great for my investors, and it worked out for the seller too. In more than one cases, we used longer than usual rent back as concession since the house was for rent anyway. So I love these win-win solutions. While the market has shifted, many sellers still have the last 2 years seller's market ingrained in their brain. So there are some sellers' denial still going on right now, and it takes a lot of patience and negotiations. So on both the lower than listed purchase price deals that I had, the sellers entered a contract with their financing buyers, of course, with a higher price being offered. But once getting into the contract and then checking the financing against the current rate, the buyer no longer qualified under the new rate, and therefore they were back on the market. Then the sellers started looking at lower offers with cash much more seriously. And that's now happening in many markets around, and managing and communicating these expectations is now a big part of the negotiation to reach that win-win. List price, on the other hand, are slightly more difficult to predict. That's because housing is very local. Not everyone, including the seller and the listing agent, are up on the condition of the economy. Not everyone has gotten that memo, but we are seeing more instances of price drop after 2 or 3 weeks of not selling. So the cooling effect of the higher rate is already working, Mr. Powell. The eligible buyers pool is getting smaller, and that's forcing demand to be lower. The economist Mark Zandi at Moody's Analytics believe that the housing market is not going to crash like it did back in 2000, but there will be a correction of maybe 5 to 10% price reduction. On the other hand, other analysts like Bank of America economists warn that the low supply will likely drive prices up another 15% this year. And the general consensus seems to be that really just not at an accelerated rate. I think that's a good thing since home prices growth have been completely out of control. And I think it is a healthy sign that things are beginning to cool off. Keeping in mind real estate is very much local, and not all markets are going to behave the same. So this is a very confusing time for sure. Different factors playing out in the marketplace. If you are still in the market for a home, make sure to check with your lender, get an updated loan approval. Look at your whole picture and reassess your needs and wants. Chances are you will need to make some compromises. For people who are buying new constructions, please make sure to check in with your builder, lender, and understand where you are with your new builds on the scheduled completion and your own loan qualification. We have seen many cases where the buyers bought the new construction back when the rates were below 3%. And at the time when the house is finished, quite a few months later, they found out that they are priced out of the house at that new higher rate, since they cannot lock in the loan rate for that period of time until the house is completed. So one last thing, whatever you do, please don't take advice from these ladies from Selling Sunsets. It's a great show and very entertaining for sure. But real estate or investment tips to risk your hard-earned money? Well, at least maybe not during the volatile and confusing time like right now. Was the information and perspective helpful? If you would like someone to talk to about your situation, text, call, or comment below, and I'll be happy to consult with you. And finally, happy Pride Month. May you always find a safe place in where you live, your community, and your home. We love you, and let's make it a great day.